Hello and welcome. It's Chad Payne here, investment advisor with Security First Asset Management, with our weekly market wrap for February 10th, 2023. A couple of announcements as usual. We've got our StubHub gift card giveaway for the first quarter. All you got to do is refer a friend or a family member to us, and your name will be put in the drawing for our first quarter StubHub gift card. Also, a couple of other notes: our 1099 schedule for Pershing or Madison Avenue Securities accounts. There's a couple more waves that's still to come. February 15th will be the next one, February 28th, and then finally March 15th. So if you haven't already received a 1099 from them, should be one coming your way soon. We may be able to help you get a little advanced copy. Sometimes they're available to us in our NetX system. But if you're about to file your taxes and you don't have it, let us know. We can help you out. So in the market last week, overall, the capital markets in the U.S. were down slightly. There wasn't a lot of economic data that came out last week that pushed markets one way or the other. So it was a little still a hangover effect a little bit from the previous payroll number that came in on the previous Friday, higher than expected, which leads to people to think that the Fed will have to be more hawkish on their rate hikes for longer. So we'll have to wait and see how that plays out. There was the market did hang on every word that the Fed said last week. There was a day where Jay Powell's comments seemed to be a little dovish and the market went up. And the next day, some other Fed members seemed to be more hawkish, so it went down. So a lot going on right now with whatever the Fed says or what people interpret the Fed saying. Consumer sentiment was up slightly for February, which is good. It's as high as it's been since January of 2022. So that's a positive for what people at least are feeling or thinking that the economy is doing. But we did see that the Treasury yield curve continued to invert. It even spread out even more, which means the short-term Treasuries, the 2-year end, were higher than the 10-year Treasury. So we've been in that situation for a while now, but it's even a wider spread. So could look at it a couple of ways. I feel like that people don't think that the high rates are going to stick around for very long. So we'll see what happens. Also, because of that, our debt servicing for the United States government debt or treasuries is higher than it's been in a long, long time, maybe ever. It's up 41% from a year ago, just for the first 4 months, most recent 4 months of the fiscal year. $198 billion is just the debt service or the interest payments on the federal government debt. So that's another thing that leads people to believe that we're going to try to get back in a lower interest rate environment sooner rather than later. So a couple more things. We've got some good fixed interest rates that are yielding high rates of return for fixed annuities as well as CDs. That's the flip side of this higher interest rate environment. We are able to take advantage of that on the savings side. And then for what it's worth department, the Kansas City Chiefs won the Super Bowl this past weekend, and that says if the AFC team wins, the stock market is usually down. So the for what it's worth part is last year the NFC team won and the stock market was down. So we'll have to wait and see what happens. But if you need anything from us, don't hesitate to call Security First. Thanks a lot. Have a great week. Bye-bye.